good afternoon, dear members, faculty of today's program, CA RINTA Anthony, my dear secretary, CA Satish TG, president of Women's Club of THRISSUR branch, CA Soumya Jaganesh, members sitting online, my dear committee members, other members of Women's Club. Good afternoon once again. And today, THRISSUR branch, in fact, has planned short sessions as a refresher of accounting standards and auditing standards. Now, almost a short sessions are there, and it's obviously you can just take it as a refresher course. And as part of this sessions, we have a VCM related to accounting standard 10. Now, obviously, we all know that the objective of AS 10, the property, plant, and equipment, is to prescribe the accounting treatment for property, plant, and equipment, so that the users of these financial statements can discern information about investments made by an enterprise in its property, plant, and equipment, and the changes in such investments, obviously. Now, the principal issues in accounting, these are the recognition of the assets, the determination of their carrying amounts, and the depreciation charges and impairment losses. Lots of areas to be recognized in relation to them. So we will be having an BCM on the same, and obviously our lecturer, I understand she's a very expert in this field. She has been associating with a Big Four firm for a few years, in fact, a KPMG. And even though I did tell that she is from THRISSUR, presently she is residing at Scotland. And on behalf of THRISSUR branch, I do welcome CA RINTA Anthony to this lecture. So I also do welcome CA Soumya Jaganesh, President, Women's Club of THRISSUR branch of ICA, to this VCM. Now, I must mention my appreciation to the Women's Club of THRISSUR branch of ICA, one of the most active branches, Women's Club branches in the entire South India, led by the very dynamic President CA Soumya Jaganesh and the very active Secretary CA Preeta Shenoy, for identifying our speaker of today's session. I must mention that they had promised that more speakers from THRISSUR will be identified by them. So I do request the members of THRISSUR branch to encourage this very wonderful initiative of Women's Club of THRISSUR branch. Now, I also do welcome other attendees assembled over here. I must welcome my very efficient secretary, CA Satish TG. Before closing out my welcome speech, I will like to remind 2-3 things to the general things to the members. Obviously, the ARS, it's expiring on this May 31st. Now, I had told about the 21st World Congress of Accountants, and June 30th is the early bird expiry. Now, almost 5 members has come forward for the physical program. So, if any other members are interested in attending the physical program, I can just connect yourselves, so that the branch is making an database about who all are going. So kindly do be in touch with me if you are registering for the 21st World Congress of Accountants. Obviously, it's the first time that is being held in India. The video has been played before the BCM. Now, one more important thing is the campus placement. Now, graduates and final year graduate students, they are being given an opportunity to work as audit assistants with CA firms. Especially in this scenario, we see CA firms, we are finding a dearth of students. So now the only option that we need to is looking into getting these graduates or final year students, graduates especially, as employees or something like that. Obviously, there are lots of skill sets in these recent graduates that who had graduated from these colleges, and lots of colleges are there in THRISSUR. Now, THRISSUR branch has been reaching out to many colleges in and around THRISSUR as part of this initiative from SIRC, and most of the colleges has expressed interest. And so I do request the firms of THRISSUR to kindly register for this initiative if you need or are in requirement of this audit assistance. The final nitty-gritties about the same will be shared later by the branch. Now, I would like to inform the members about the coming programs. Now, we have one VCM this 27th on RIRA, and it's in a virtual meeting. And I do remind the members on the National Conference of GST on the 28th and 29th in Palakkad. And we have a CP seminar at branch premises on 30th on GST. Also, we had planned in a sports event for the members. Obviously, last 2 years, we did not have any opportunity to meet even for the sports events. And at last, this time, we are hopeful that we can conduct the sports events. And please do make yourselves free on 4th and 5th. We had prepared a detailed schedule on the sports event, and also in a small part of the sports will be done on 12th also. So 4th and 5th next month, do make yourself free. And there is a CP seminar on 4th also. So on 4th, you need to make yourself free for the entire day. And these are some of the programs that we had planned. And thank you very much. Now, before moving into the giving the stage to the speaker, I would like to invite the very dynamic president of Women's Club of Trichure branch, Soumya Jaganesh, to introduce the speaker.
Thank you, Mr. Rajit. Good afternoon, everyone. I'm here to introduce CA RINTA Anthony. CA RINTA had qualified CA in 2017 and has been working with one of the big fours, KPMG. And she has grown from executive to assistant manager there. She has handled clients in almost all the sectors from banking, healthcare, real estate, energy, software, so on and so forth. She has also worked for KPMG Dubai and KPMG US for a short span of time on secondment. Ms. RINTA has experiences in auditing and assurance services, financial reporting, and accounting advisory services. She has secured various awards while she was working with KPMG. She has been the district topper during a CA entrance examination, and she has also been a school topper for the AISSE. She has also presented a paper in ICDS in the National Conference of ICAI held in 2017. She's currently with KPMG UK, working in Scotland Financial Services as an assistant manager, handling asset management. Looking forward to her presentation on AS10. Thank you.
So over to you, RINTA. The stage is yours.
Thank you, sir. So before I start my presentation, I really wanted to thank THRISSUR Institute because from my CPT to my finals, including my articleship, everything was in CA THRISSUR Institute, and I was active in SICASA as well. So thank you, everyone. So whatever I have achieved so far, I haven't achieved much though, but yeah, whatever stages I've come through at till my professional career, the base is at THRISSUR. So still, I was a science background, and thank you so much to the THRISSUR Institute. I was the first batch where THRISSUR Institute has given a separate batch for science students, and that made me a district topper. So thank you so much for all the guidance. Even I've got Vasan Shivaram, which was my very base during my articleship. And till now, from there to Big Four, though it is KPMG, I was based in Cochin. So everywhere, I was able to gain a lot of experiences. So everything, thank you so much. Thank you, THRISSUR Institute, always THRISSUR, it's always in my heart. And happy to see everyone again. Like after a long gap, I am presenting something in THRISSUR. So thank you so much for this opportunity, and thanks Preeta for calling me. Like she asked me, it was very short span, so I try to make as much as possible, but not lagging much though. So as told, like today the presentation will be overall on plant property and equipment, IS-10, and the whole coverage will be on the scope, recognition, measurement, depreciation, impairment, retirement, and derecognition. Starting with the scope of plant property and equipment. So this is like a scope of the standard. So this standard applies for plant property and equipment. So whatever plant property and equipment includes all tangible assets, but some of the tangible assets or whatever covered in this definition could be dealt by any other standard, like a leases for a plant property, and plant property could be covered under leases that is not covered under AS10. So the scope of this standard is plant property and equipments, excluding biological assets and wasting assets. So what is biological asset? A biological asset is something, a living asset. So whatever a livestock, a plant, or whatever is categorized as a biological asset, that is related to agriculture activity, but it excludes bearer plants. A bearer plant, it can be explained easily with an example, like a tree, a mango tree or a coconut tree, or even rubber plants. So that will give out their produce for more than 1 year. So these all are covered under this standard, bearer plants, but biological assets are not covered under this standard. And wasting assets, it is can be easily explained by a mine and their expense related to it. It is also not covered under the standard. So now we know what is plant property. We want to understand what is plant property and equipment. So plant property and equipment are something that is held for use in the production or supply of goods or services or rental for others or for administrative purpose, and expected to have a lifespan more than 12 months. So this is quite important because for administrative purpose, though it is very strict, very tricky one, because we can see, for example, if a company which is working under which is under like manufacturing, but still we can see we are capitalizing cars or computers. So this all are capitalized, and this comes under PPE because it is also used for administrative purpose. So this is the definition of the PPE. So from here, we will go out with how this whole standard covers. And I promise I will not take up much time because I have never ever heard any training sections more than 30 minutes. So I'll try to limit it to it. And now we will go out with recognition of PPE, which is the very important thing because this is the very high-end questionable part as being an auditor, the recognition dates, recognition cost, and the base why they are recognizing it. So now starting with how an asset is recognized, like when an asset is recognized and why an asset is recognized. An asset, a PPE, so which meets the definition, as I said before, will be recognized when it is probable that the future economic benefit will flow into the enterprise and cost can be reliably measured. So future economic benefit, it is a very outlined portion because this can be direct or indirect. We have seen sometimes some structures like car park or something like that getting capitalized. So that is not expecting to have a direct future economic benefit to the company, but still we capitalize it because indirectly it is providing some employee benefits, etc. So whatever, it can be a direct or indirect future economic benefit to the enterprise, then we will consider capitalizing it, and cost can be reliably measured. So what is cost? So cost, it is specifically defined in the standard, but it is a very high-end part of question whenever we do the auditing, because cost as per the standard, it includes purchase price, import duties, non-refundable purchase taxes after debiting trade discounts, rebates, etc., and any cost that is attributable to bringing the asset to the location or a condition, make it intended in the to be used in the manner intended by the management. So this is very tricky part. Like some of the costs is, they will argue with us it is required, some of them not. But yeah, this is easily like the cost is like a trial run cost or a transportation cost that is getting capitalized to it. So we will always question the management how we can say this directly attributable to this asset. So this is a very huge part of question. And also it includes initial cost of dismantling. So why this happens, dismantling cost? So for example, if an asset, it is in a lease land, so we are on a lease land, and for example, if it is like a generator or something, so that has to be used, we need a specific structure. And since it is a lease land, after the lease period, we have to demolish it, like destroy it and give it as in the initial way how we have received the land, we have to get back to the lessor. So there is a cost that has to be incurred by the management to bring it back to that condition. So initially, it is really hard for us to estimate it, but management will definitely do a estimation, and they have to capitalize that as a part of this PPE. And there will be changes in this estimation over the period, which is dealt subsequently in this slide. And this is like a very tricky part. Like I haven't seen this capitalization much in this assets wherever I have worked, but happy to know if anybody has done it. Like, but yeah, this is something very tricky part. And once the asset cost is arrived and we have capitalized it. So when we will capitalize the asset when it is ready for use. So ready for use after the trial run, now it can be used for the intended purpose. Based on that date, we will capitalize the asset. So there will be always a doubt on the capitalization, because when we verify the invoices, the invoice date will be something and the capitalization dates will be different. And there will be always a question on that with the management, why there is a difference. So this is, they will be having a capitalization certificate on most of the asset they brought up, which was stamped by their expert or particular industry expert, like particular department experts. So based on that date, we will get comfort over this, but that is very important because depreciation is all based on the capitalization date. Once the asset is capitalized, now the question is on how the subsequent recognition is done. So as per the standard, there are two ways to carry out the subsequent things. Like either they can follow a cost model or they can follow a revaluation model. So cost model being like, so whenever a company on their accounting policies, like every company is expected to have an accounting policy. So they will always mention which is the model they follows, either a cost model or a revaluation model. It's all based on that. If they are following the cost model, the carrying amount of the asset will be very simple. It's less accumulated, the carrying amount, like the amount cost, less accumulated depreciation, less impairment losses. So if they are carrying that asset at revaluation model, it's very hard, like, because there are a lot of processes. So once we are carrying at revaluation model, the management will have a particular time periods over which this revaluation of that asset class, because one asset is revalued, the whole class has to be revalued as per the standard. So they will have intervals by which they have to carry out the revaluation of this asset. And based on that revaluation, the carrying amount will be adjusted. So the valuer should be independent to the entity and should always possess required qualifications to carry out the revaluation. So at times, as I said, there can be a 3 years or 5 years fixed by the management to carry out the revaluation. But if there is any occurrence of a particular event, like if specific law has come, like we cannot have a construction or something there, or if any highway is going ahead, like near to that land, there could be a chance of appreciation in the value. In all those cases, management will consider of revaluation, but they will always have a particular time interval where they have to carry out the revaluation. At times, some of the acts specify like they have to revalue the assets within this time. So all this will be considered for the revaluation period. So once the asset is revalued, there can be appreciation in the value or depreciation, like value might increase, value might decrease. So if there is an increase in the value, then it has to be charged off to the, like, we will have a specific thing called revaluation surplus that is specifically disclosed in the SOCI, like statement of equity. We will have a separate disclosure of revaluation surplus, and we will also have a note on that, because whatever reserves we give out in SOCI, we have to give why it is there, like what does that reserves represents. So when the revaluation, why, what is the moment, everything has to be separately disclosed. So so we will bring out, we will get credited to the revaluation surplus in the reserves and surplus. And if there is an opposite, like if there is a decrease in the value, then we will charge it off to the profit and loss account. So once, if we consider a scenario, initially when we have charged it off to the profit and loss account, and in the next time when we revalue the asset, if there is an appreciation, like there is an increase in the value, then to the extent it was charged off to the profit and loss account, we have to put it as we have to account it as an income and statement of P&L, and the rest we have to create it as a revaluation surplus. So this is on the accounting of like accounting under cost and revaluation models. And next is the very, very interesting one. It's all on depreciation, because it is the major area where there can be a misstatement, because either error in the correction or fraud, because they, as I said earlier, they will always consider, that is always the confusions on the date on which the asset is capitalized. And so, okay, starting with depreciation. Depreciation, as we know, there is something called depreciable amount, and it is allocated systematically throughout the useful life. All these words, depreciable amount and useful life, all have a specific definition. So depreciable amount is quite easy. It is the cost less residual value. So residual value is something what we are expecting to receive from this asset at the end of its useful life, like by sale or something else, like mostly by sale. So how we are expecting to get it. So this is a management estimate, residual value. So there is some changes or things like every balance sheet, they are expected to check on their useful life and residual value, since they are estimates. So next one is on the useful life. So useful life is like mostly in India, we follows Companies Act, and all asset which are capitalized will be based on different classes mentioned in the Schedule 2 of Companies Act. But and the Companies Act specifies the useful life. But accounting standards, what it says is like useful life is the time period where the asset can be used by the management for the intended purpose and economic benefit is expected to flow to the entity. So, but when we are determining this useful life, we will always consider a lot of things like usage, physical wear and tear, technology, obsolescence, and legal matters. So useful life, as I said, it is mentioned in the Schedule 2, but I've come across situations where they have used different useful lives. This is all based on the management experts report. So wherever they give us a different useful life, they will give us a report from their previous experiences, that is all management experts, on why they are using a different useful life. And we have to disclose it also in our accounting policy, why we deviate, why like it is not, we have to disclose the useful life as per the standard, but as a management policy, most of them prefer why they have used a different useful life. Mostly they say like because of the management experts thing, they use a different useful life. So once the depreciable amount useful life is set, now we can depreciate the asset, but there are different ways by which we can depreciate an asset, like different models. We have got a SLM, WDV, and based on units of production. But most of the clients we have come across, it is either WDV and SLM. I personally have worked, most of them was SLM, which is the most easiest one. So once SLM is like, or if, for example, if the cost is 1 lakh and the useful life was 10 years, straight away 10,000 every year to it. So, but in our companies that if you're following companies that it has specifically given how the percentage will be when it is at SLM and when it's at WTV to reflect it. So we will depreciate the asset and it will be charged off to the profit and loss account. So as I said, this is a very core area being an auditor, and very high end questions comes up in depreciation, because there is another concept called component depreciation, especially like if it is a very high valued equipments. I have seen it in high valued equipments, especially in hospital industries and all, where biological equipments, where the total useful life of that asset could be 10 years, but to make that asset to be used for 10 years, a specific part has to be replaced in either could be 3 years or 5 years. So if we and a biological, so every hospital industry, if you consider, they will have a expert on that machinery who will have the whole idea of how the cost is and how much is the useful life of it. In with respect to it, there is, as an auditor, we always question on how they arrive it, but they will always maintain a report on how they arrived at this useful life for that particular part, and they will also provide us with a past trend. So if we have that cost and the useful life of specific part, we can depreciate it. So we will depreciate it for 3 years if that life is 3 years, and this is called component depreciation. And so we will adjust this component depreciation to the total depreciation. So how I have seen the working is like they will compute the total as a depreciation, and they will remove the depreciation for that particular assets. They will adjust the component depreciation specifically on mathematics. This is how the depreciation is charged to the P&L. So as I said, like there is useful life and residual value, they are accounting estimates. There will be changes in them because every balance sheet date, the management is expected to have a view, like they have to review, is the useful life used is correct or residual value is correct. So there is any changes, this has to be dealt by AS5. And also we know WDV or SLM, they are accounting policies. So if there is any changes in them, this also has to be dealt in accordance with AS5. So far we have come across, it's like in PPE, like this depreciation cost and everything is like, we can see it in every companies. And this is like a question always come up to the management on the ownership depreciation computation, because, and even Caro, we have to say on the fixed asset depreciation, their existence. So far it is covered on a daily things. So next few slides is very like we'll never come across like most common, but though very important. So the next one comes as a change in the existing, decommissioning, restoration, and other liabilities. So when we capitalize an asset, like a building or something, so once asset could have been created, but on the balance sheet, like the day it was capitalized, most of the invoices, we couldn't have received the total invoices. Some things could be under negotiation, but this on that day, since the management start to use the asset, we have to capitalize it because we will get a capitalization certificate, it is ready for use, and the management start to use it. So as per the standard, we have to capitalize it. But there will be a question on the cost, because the cost is not yet finalized. So what we will do at that scenario, what I have personally done it based on their capital contracts, we will have a provision for whatever is the difference. For example, if the total contracts was for 1 CR, and till now the invoice is reached up over 75 lakhs. So that 25 lakhs, we will create a provision for capital creditors, and then we will capitalize that assets. But there are chances it is under negotiations because of some managements and the other ones, like always there. So most of the cases it is there. So negotiations might be in progress, by which we will not be liable to pay out this like 25 lakhs. We might be at 10 lakhs. And also this is that causes change in the liabilities. And also, as I said, in the part of a cost, we have to have specific structures, and we have to include the decommissioning or demolishing, decommissioning or restoration cost also has to be part of the cost of the asset. So in that is an estimate. There will be changes in that as well going ahead. So all these changes, this has to be adjusted to the either to the carrying amount or the revaluation surplus, all depends on the model the management follow. So if it is at the cost model, and if there is any increase in the liability, what we'll do is we will credit the liability and debit the assets. But when we are increasing the asset, because the asset value should be always, there is another concept of impairment. So when we increase the value of asset, we have to definitely have a thing in mind with respect to their impairment part. So if that increase is like, if the asset value considering impairment is less than the decrease, the rest has to go to P&L. It will never get capitalized to the asset. So if there is, if next one, if there is any decrease in the liabilities, then asset value should be decreased. So if it is more than its carrying amount, charge off to the P&L. And in case of revaluation model, already if any revaluation surplus or deficit was recognized in the statement or in the revaluation surplus part. So if there is a decrease in the liability, so there is a debit to the liability and credit to the revaluation reserve. But initially, if there was a profit, like we know in the revaluation model, if there was a decrease in the revaluation in the previous time when the asset was revalued, that could have been charged off to the P&L. To the extent that difference, it has to go to an income in the P&L. For example, if last year in 2021, 2021, if there was a revaluation deficit of 1 lakh and it was charged off to the P&L, and the change in the liability is 25,000. So this 25,000 will go to income in the P&L rather than to the revaluation surplus. And increase in the, and next one is the increase in the liability. So if there is any increase in the liability, so it should be recognized. So it is credited to the liability and recognized in the P&L. This should be so if there is any revaluation surplus coming up, then up to that asset, it has to be adjusted to the revaluation surplus. Okay. So that is on the adjustment. And next one is the very interesting part. It's the impairment. So far in the slides, I've been speaking much on this impairment, and it is totally dealt in other standard AS 28. But though it is a very interesting part for me because I was wholly involved in the impairment testing, and it was very interesting thing. So impairment loss. Impairment loss is coming when the carrying amount of an asset is less than its recoverable amount. So what is a recoverable amount? A recoverable amount is the higher of net selling price and its value in use. So net selling price is, it's like if an asset we are selling it today at an arm's length transaction. So how much we are expected to receive from that transaction is the net selling price. So mostly we will be able to get it from the subsequent sales in the same market, everything based on the internet search. So we will have an experts in that. So from what we will get the net selling price and the value in use. That is the very, very interesting thing. So if a company has is in losses for years, so loss can be mostly like could be a depreciation loss, business loss. So if the depreciation amount is higher and the company is in losses, so there is a trigger of impairment, because depreciation should be a systematic allocation of depreciable amount, and the method we follows should reflect the future economic benefits. So if because of depreciation, if the company in losses, then there is a trigger that there is impairment, where we have to see there is other triggers that is detailed in AS 28. So I'm just saying on my personal experience. So if there is any impairment, so we will definitely request management projections. and their impairment workings. So usually what I have seen in their impairment working is that they will have a cash inflow projections based on by the use of this assets, and they will consider a lot of facts. There will be increase in the sales expected for everything. They will have a explanation why they are doing this. This impairment has to be approved by the board as well. So with all that explanation, we as an auditor will question definitely why we have if they consider 20% increase in the sale next year, how 20% sale. So all these questions will go. So based on this management workings, they will have a cash inflow from this use of asset. This inflow will get discounted. So how is this discount factor? So discount factor is mostly computed using CAPM. So that has got RM, RF, the thing we have learned in our IPCC and CP like finals. So when I was learning, I don't know that will have such a big use in my life, my professional life. So there RF, RM. So RF will be arrived with RM and beta and alpha. So usually I have seen the people using the beta RM and all with the modern site. They will take it and they will find the RF. So based on this RF, they will arrive at the value in use and they will just do a comparison. So if the impairment is considered, mostly the impairment testing, so missionaries, net selling, because we will get a comfort our net selling price in most of the cases because of the land value and the building appreciation, like building values. But sometimes we will have a question on the value in use, whatever. So either higher of this will be considered. And if the carrying amount is more than that, then we have to charge impairment losses as well. And next is on the retirement and derecognition. Both of this can be considered in one go, because an asset is expected to be retired because when it is held for sale, we have seen in some financials under PPE, we can see assets that is held for sale, which is no longer required by the management because they know future economic benefit is expected to flow into the entity by the use of that assets. So when an asset is recognized on disposal, or as I said, no future economic benefit flow into the enterprise, we will move it into held for sale category and is disclosed under PPE. There will be fixed asset, tangible, intangible, work in progress, and held for sale. So this thing will be there. And if it is like an ordinary activity, if that fixed asset was held for rental purposes and it's ordinary that after useful life it moves, it got sold, then that becomes an inventory for that company and dealt by AS9 revenue recognition. And next we goes to the last part of it. It is on the disclosure. So so disclosures is very important because we have to give while making the disclosure, the financials, we have to follow Schedule 3, as well as we have to make sure that everything as per the AS is also disclosed. So as per the accounting standard, we have to specifically disclose the measurement base. So it is like, as I said, if it is a cost model or evaluation model, so we have to disclose it, and the depreciation method SLM, how the useful life and depreciation rates. So this is why I said initially, like for all asset class wise, most of it, like in the class wise, they will give us the depreciation, useful life. And if there is any change in the useful life from schedule 2, yeah. So they will specifically mention they have carried out this expert and their own past experiences. These are the useful life. And gross amount accumulated depreciation. We know the FA schedule, which is there in most of the financials, which is there in all the financial statements, where we've got the gross carrying amount, additions, deletions, accounting adjustments, and closing of carrying amount. And the same way, accumulated depreciation. So year additions, deletions, and adjustments, and the closing. So this is the format we followed, and that is like that is what the next one, reconciliation. And it also we have seen like the borrowing and all, if there is any restrictions against because most of the loans we take, we have to pledge the fixed asset. So all that restrictions on the title, everything we will get disclosed. And I've seen it mostly under the borrowings, they will disclose it. And WDV, we will have a note. So we will have a note on why there is so how much working progress has incurred so far, and and capital commitments. So that is disclosed after all the notes on contingencies and commitments. We will disclose all this. And if there is any revaluation happening, so we will have a effective date of revaluation. And when there was an independent valuer is involved, we will see who was that and how he is eligible to conduct this revaluation, methods used by him, how much is the revaluation surplus, all this revaluation surplus, all this comes as a note in the notes to accounts. So this is the total coverage on this standard. So now it's a time for any questions.
Dear members, if you have any questions, please raise your hand so I can unmute yourself. Krishnan sir, so you have raised your hand. Do you have any questions? Can I unmute? Okay, I think do you have any questions? Okay, then we can proceed further. Okay, and I think there is no more questions, so we are moving forward. That we are planned in a way that accounting standard program in some short programs. So we have planning a series of such programs, and our chairman has to make a move for some other program, so I'm taking over. Soumya, do you have anything to add?
No. It was a very nice presentation, Rinta. We all had enjoyed your presentation. Yeah.
Thank you, Soumya.
Thank you, Soumya. So moving on. Good afternoon, all. We have planned this program as a part of empowering the young members with the help of CA Soumya and CA Prida. We could find CA RINTA Anthony, a new speaker to our chapter. So I thank all members of Women's Club for taking their effort. CA RINTA has presented exemplarily well. She has gone through all AS10, that property, plant and equipment in a way that members can have easily capture the main points. So I thank CA RINTA for the effort taken, for sparing her valuable time with us. Thank you, RINTA. I also thank the members who watched us online. Thank you very much.